You know how it is. You've got these financial reports, press releases piling up, and you just need the key takeaways fast.
Exactly.
Well, think of this as your shortcut.
Mm-hmm.
Today, we're doing a deep dive into IDFC First Bank, specifically their latest financial results.
Yep. For the quarter and the full fiscal year ending March 31st, 2025.
Right. And we've got the official press release that's dated April 26, 2025.
The investor presentation from the same time, and we've pulled some bits from the Q4 earnings call too.
So the mission, basically, is to pull out the crucial stuff for you.
Performance, asset quality, profit, future plans, all that.
And what the management's saying, clearly and concisely.
Let's jump in.
Okay, let's unpack it. Starting with, I guess, the big picture. Overall financial performance sounds like there was some decent growth.
Oh, definitely. Their total balance sheet size, it grew 16% compared to last year,
16%. Okay.
reaching about 3.4 lakh crore rupees.
Mhm.
And what's really interesting is deposit growth. It's actually outpacing their loan growth.
Oh, is it?
Yeah. Customer deposits surged 25% year over year. That's up to Rs 2.42 lakh crore.
And retail deposits, often a focus area.
Even stronger, up 26% year over year.
That's impressive deposit mobilization. What about the Shanghai ratio, that low-cost deposit mix?
It held steady, around 47%, which is, quite healthy.
Mm-hmm.
And that's while the actual Kansa deposit amount grew 25% year on year, even 30% if you look at the Q4 average.
Right.
Term deposits grew strongly too, up 26% YoY overall, with retail TDs growing even faster at 28%.
And it looks like they're cleaning up some old debt as well.
Yeah, that's a key point. They've been repaying high-cost legacy borrowings, about Rs 7,000 crore in FY25 alone.
Okay.
There's only a small bit left maturing next year, and this has helped their credit-to-deposit ratio.
How so?
It's improved, down to 93.9% from over 98% the year before. So they're funding more through deposits.
That makes sense.
And they mentioned stable cost of funds and deposit costs for the quarter, too.
So deposits are strong, old debt's reducing. How about the other sides of lending?
Loans and advances also grew solidly, 20.4% year over year, reaching Rs 2.42 lakh crore.
Okay.
And there was decent sequential growth, too, 4.7% in Q4. That's on slide 28 in the presentation, if you're following along.
And where did this loan growth come from?
Pretty broad-based, actually. Mortgages up 19%, vehicle loans 26%, business banking 32%, even wholesale banking up 29%.
Right.
Plus, they highlighted good growth in smaller areas like gold loans and credit cards.
Any areas that didn't grow? Or maybe shrank?
Yes, the microfinance book, it saw a degrowth of 28.3% year over year.
Why was that?
They put it down to industry-wide challenges in the microfinance sector.
Oh, okay.
On the flip side, their infrastructure lending is now tiny, less than 1% of funded assets, a conscious reduction, it seems.
Okay, that's the growth story. Now, the crucial asset quality. How are the NPAs looking? The bad loans?
Right. As of March 31st, 2025, gross NPA was 1.87%, net NPA at 0.53%.
Which sounds okay, but is there more to it?
Well, yes. The interesting part is if you exclude the microfinance portfolio.
Yeah, that again.
Exactly. Without microfinance, gross NPA actually improved. It dropped 19 basis points from the previous quarter to 1.63%.
Okay, that's a clearer picture of the core bank.
And net NPA, excluding microfinance, also improved slightly to 0.47%.
Oh, so underlying improvement masked a bit by microfinance. What about provisions, the money set aside for losses?
Their provision coverage ratio, or PCR, excluding technical write-offs, looks healthy at 72.3%.
And how does that compare?
That's improved significantly year over year, up by 347 basis points.
Okay.
And if you look just at the retail, rural, and MSME loans again, excluding microfinance, the gross NPA there improved slightly quarter on quarter to 1.40%. Net NPA was stable at 0.56%.
So it really does seem like microfinance is the main area causing stress on the overall number.
It definitely had an impact in Q4. They saw an increase in gross NPA in microfinance compared to Q3. Their standard restructured book, though, is very small, only 0.18% of funded assets.
What about early warning signs, the SMA accounts?
Right, special mention accounts. In the core retail, rural, MSME book, excluding microfinance, SMA 1 and 2 saw just a marginal increase to 0.87%. Pretty stable.
But in microfinance?
That did increase to 5.10%. Though, interestingly, the actual value of those SMA accounts in microfinance decreased quarter on quarter.
How does that work?
Because the overall microfinance loan book itself is shrinking. So the pool got smaller even if the percentage went up.
Got it. Okay. Any good news on collections? Are people paying back on time?
Yes, they reported better collection efficiency in March 2025 99.2% overall.
That sounds high.
It is. And even higher, 99.4% if you exclude a couple of specific regions. Importantly, outside of microfinance, collections remain stable and very high.
What about new loans going bad? Slippages?
Gross slippage actually decreased from Q3 to Q4 down to Rs 2,175 crore.
Okay.
Now, microfinance slippage did increase, but if you exclude that, slippage in the rest of the book improved by about 150 crore rupees quarter on quarter.
Right, consistent theme there.
Net slippage was also slightly down. And recoveries and upgrades were stable compared to the previous quarter, around Rs 655 crore.
They also seem keen to talk about their lending process itself.
Absolutely. They emphasize their underwriting is based on cash flow assessment. That's on slide 35. It's fundamental, they say. And they pointed to improvements in first EMI bounce rates, a good early indicator of loan quality.
Right.
Their vintage analysis, looking at loans booked over time, also suggests portfolios booked post-COVID are performing better. That's slide 42.
And how do they stack up against the industry?
They included data on slides 44-45, showing their 30-plus days past due delinquency is actually better than the industry average in key retail segments, based on CIBIL data.
Okay, interesting comparison. Let's shift to profitability then. Income, expenses, the bottom line.
Yeah.
How did net interest income, NII, fare?
NII grew pretty well, 17% year over year for the full fiscal year FY25, and 15% YoY just for Q4.
Yeah.
And again, if you exclude microfinance, the FY25 growth was also around 17%. So core NII growth is strong.
But what about the margin, the net interest margin, NIM?
That did moderate a bit, came in at 5.95% in Q4.
And the reason?
They mainly pointed to the drag from the microfinance business again.
Understood. What about other income sources, like fees?
Fee and other income was up 15% year over year for FY25 and 6% for Q4. And retail fees make up the vast majority of that 92%.
Expenses. Are they managing costs?
It looks like it. Operating expense growth seems to be slowing. It's 16.5% for the full year, but only 12.2% in Q4.
So potentially showing some operating leverage, income growing faster than costs.
Exactly. That's the trend they're aiming for.
How did that flow through to core operating profit?
Core operating profit, that's NII plus fees, stripping out shading gains, grew 17% YoY.
Without microfinance?
Much stronger. 31% year-over-year growth, excluding microfinance.
Right, but provisions were high, you mentioned.
Yes, total provisions for FY25 were Rs 5,515 crore. That's 2.46% of the loan book, largely driven by microfinance provisioning needs. But the credit cost, excluding microfinance, and one specific toll account was lower, 1.76% for the year, and it was improving sequentially in Q4. They also had some contingency microfinance provisions of Rs 315 crore that they didn't actually need to use in Q4.
So after all that, what was the final profit after tax, the PAT?
The reported PT for FY25 was Rs 1,525 crore.
Which is?
Down quite a bit, 48.4% compared to the previous year.
Largely due to microfinance, as they say.
That's the narrative, yes. For Q4 alone, PT was Rs 304 crore. But management sounds pretty confident about a rebound.
A recovery post FY25.
Yes, they expect a smart recovery, basically saying the microfinance hit is largely absorbed now, and operating leverage should kick in.
Are any specific business lines looking particularly promising for future profit?
Well, they made a point about their credit card business. It hit operational break-even within just 4 years.
That's quite fast.
It is. They expect it to be PTA positive in the next couple of years and, quote, spinning cash by FY28-29.
And the asset quality there.
Stable, apparently, with improving credit costs. They also mentioned the retail liability side gathering deposits is seeing its operating losses shrink relative to the deposit base. So moving towards break-even there, too.
Okay, let's talk capital. How strong is their buffer?
Pretty strong. Capital adequacy ratio, CAR, is at 15.48%. And the core equity, CET1, is 13.17% as of March 31st. That's post-dividend payout.
Ah, so there is a dividend.
Yes, the board recommended Rs 0.25 per share for FY25, subject to shareholder approval, of course.
And the big news, they're raising more capital, aren't they?
That's right. Board approval is in for raising about Rs 7,500 crore in fresh equity.
How are they doing that?
Through compulsorily convertible preference shares, CCPS, issued to two big names, an affiliate of Warburg Pincus and a subsidiary of ADIA, the Abu Dhabi Investment Authority.
Subject to approvals, naturally. What's the rationale? Growth fuel.
Essentially, yes. It significantly boosts their capital base for future expansion without straining ratios. A strategic move, especially now.
What are the terms on those CCPS?
The conversion into equity is tied to the stock price performance needs to stay above R60 for a period. Until then, the investors get an 8% return.
And post-conversion, what does it do to the ratios?
Based on March numbers, it would push CRR up to around 18.2% and Tier I capital to about 15.9%. So a substantial boost.
Okay. What about liquidity?
LCR. Liquidity coverage ratio averaged 107% for the quarter, ending Q4 at 117%. Their target is to keep it around 115%.
So looking forward, what's their guidance for this year, FY26?
They're guiding for loan growth around 20% and deposit growth slightly higher, around 22%.
Then costs.
They want to keep operating expense growth capped at 12–13% to drive that operating leverage we talked about.
Any guidance on credit costs?
Yes, they expect about a 50 basis point reduction in credit costs for FY26, so landing somewhere in the 1.85–1.90% range, down from the 2.46% in FY25.
And
They expect a slight moderation there, maybe 10 basis points lower in FY26. They attribute this to potential repo rate cuts and their own planned rate adjustments on some deposits.
beyond the numbers, what's the strategic focus? What are they trying to build?
They keep talking about building a quality franchise. Strong customer experience, digital capabilities, ethical banking.
Like the app ratings they mentioned.
Exactly. And the Forrester recognition. A key strategic piece is definitely continuing the shift towards retail deposits.
Right. You said that's 79% now.
Yes, up massively from just 27% at the time of the merger. The goal is to get the loan-to-deposit ratio down into the high 80s in the next few years.
Become more deposit funded.
Precisely. Long-term, they want borrowing levels comparable to the banks with the lowest borrowings in the industry.
And how's management framing FY25's lower profit in this context?
They position it as largely due to the microfinance issue and industry problem they stress. They seem very confident they'll get back to their, quote, winning ways from FY19-24 starting this year.
Based on the core business strength.
Right. And they're focused on efficiency drives to both operational cuts and using tech like automation, RPA, bots to manage OPEX growth.
We're hearing a lot more about ESG factors these days. Are they highlighting that?
They are. They mention strong ESG scores, commitment to financial inclusion, social responsibility, financing millions of customers, including lifestyle loans, women entrepreneurs.
Is it integrated into their structure?
Seems so. They have a board ESG committee, management committees, even an ESG business unit. Their S&P ESG score improved. They joined the FTSE4 Good Emerging Index, became a PTF signatory.
Any specific examples from FY25?
Yeah. Green certified offices, green energy use, EV charging, sewage treatment plants, employee volunteering hours, CSR impact, plus things like board independence, women directors, ISO security certification.
And awards. Banks always like to mention awards.
Yes. They listed quite a few across green finance, inclusion, ESG, digital governance, and also noted an improvement in their brand awareness, their Tomei score.
You mentioned the merger earlier. Maybe quickly touch on Capital First's story before the merger. Why is that relevant?
It's relevant because it forms the foundation of a large part of the merged bank, particularly the retail and MSME side, and the leadership. Capital First had a really strong run before merging in late 2018.
In what way?
Consistent AUM growth, a successful turnaround to profitability after V. Vaidyanathan took over, improving cost efficiency, rising ROE, and importantly, the stock price multiplied about 7 times in the 6 years leading up to the merger. So it shows a track record of that business model and leadership team.
Got it. And any specific comments from management on the microfinance outlook now from the earnings call?
They acknowledged the new MFI guidelines implemented in February did slow down disbursements in Q4, but they said collection efficiency in microfinance picked up in March and April, getting back to levels seen a year ago in Q4 FY24.
And the provisions?
Their view is that the peak provisioning for microfinance happened in Q4 FY25. They expect those provisions to reduce going forward.
We touched on credit cost guidance, but just to reiterate for FY26.
Yep, they're guiding for the 1.85% to 1.90% range. That's down significantly from the 2.46% in FY25, which included that big microfinance impact and the toll road provision.
And finally, a quick word on the leadership, the board and CEO.
Experienced board, diverse backgrounds, global banking, finance, even former RBI members. And the MD and CEO, V. Vaidyanathan, obviously key. His background includes Citibank, ICICI Bank, and then the successful build-out of Capital First before leading the merged entity.
Okay, so let's try and wrap this up. Key takeaways from this deep dive.
Well, strong growth in core areas, deposits and loans, excluding microfinance.
Right. Improving asset quality trends in those core segments, too.
Definitely. A real focus on operating leverage, cost efficiency starting to show.
And that big capital raise, positioning them for future growth.
Can't forget that. It's significant.
But you can't ignore the short-term impact from the microfinance sector. It clearly dragged down the FY25 numbers.
True. But the underlying story, the management narrative at least, is one of fundamental franchise strengths and a positive long-term outlook.
That credit card break-even is interesting, too. Shows they can build new profitable lines.
Yeah, operational break-even in 4 years is pretty good. And the capital raise gives them that runway, that firepower for growth without stressing the balance sheet immediately.
So the picture is strong core, weighed down by a specific sector issue, but signs of improvement and a strategic shift, especially on the funding side compared to the merger time.
Exactly. Which leads to a thought for you, the listener.
Mm-hmm.
Given everything we're seeing economically, how do banks like IDFC First really balance that drive for fast growth against the absolute need to keep asset quality high?
It's the classic balancing act, isn't it?
It is. What factors do you think will be most crucial for them hitting their targets in the next year or two? Something to chew on.
Definitely food for thought. And of course, if you want all the fine print, dig into those source documents, the press release, the presentation.
Yeah, definitely worth a look for the full detail.
Think about how their strategy fits the wider Indian banking scene. Maybe explore digital transformation's impact or, the sustainability of these high-growth models long-term.
Lots to consider.
Thanks for joining us on this deep dive.